We're going to use SPY today as today's example. First thing I want to say is I'm not a financial advisor. This is strictly for educational purposes. Okay, guys? Okay, today we're going to go over discussing option trading for beginners. Okay, options are a type of financial instrument that gives you the right but not the obligation to buy or sell 100 shares of a stock at a predetermined price. Okay, by a date, an expiration date. Now, buy or sell 100 shares of a stock. That is correct. That is exactly what options is. When you buy a contract, it's basically giving you the right to buy 100 or sell 100 shares. Okay, each contract is 100 shares. So let's go into the contracts here. Let's go into the trading options. And let's break it down first. So why would someone want to trade options? Well, they offer a lot of flexibility, can be used to generate income, hedge against risk, or speculate against market movements, okay? But let's go down and break the components of these key components of just options, okay? First, you have the strike price over here, okay, guys? Then you have the expiration dates, which is the date by which the option must be exercised. And finally, you have the premium, okay, which is the price you pay to buy the option. There are two types of options, calls and puts. A call option gives you the right to buy the underlying stock, while a put gives you the right to sell the underlying stock. Basically, if you think the price goes up, you're buying calls. If you think the price is going to go down, you're going to buy puts, all right? Now, I like to use the A in call and the U in put to indicate arrows, okay, guys? As you can see, calls has an A point. It's like an arrow pointing up. So when you're betting that the price of the share will go up, we're buying calls. U is like a downward pointing arrow. So when you're betting on the option to go down, you're buying puts. When you're selling options, it's reversed. So I like to actually take the words and flip them upside down. Now the A is pointing downwards. So we're selling a call is because we want the price to go down. And when we're selling a put, the U is now pointing up. So we want the price to go up. Feel free to take a screenshot of this for remembering it. But okay, guys. Let's talk about the Greeks. And when you open up a contract here, you can see the Greeks down here, okay? And there's going to be two main Greeks that I really always look at, and I think everyone should at least understand, okay, guys? And that is going to be delta, and delta measures how much an options price will change for every $1 movement in the underlying price of the stock. Okay, guys, so if a dollar moves up or down, your price of the contract will move up or down by this amount. Okay, 43 cents is this delta. Now, gamma measures how much delta will change for every $1 movement. Okay, so this will eventually change for every dollar movement, either up or down as well. Okay, guys. And then theta measures how much an option price will change as time passes. This is time decay. Okay. Basically, for every single day that goes by, this contract loses 51 cents. Okay. Which ends up being $51. So it decays really quickly. The decay is more based on how close your contracts are to expiration. Okay, guys. And then finally, let's talk about implied volatility. Okay. And it is a measure of the market's expectation for how much of the price will move in the future. Higher IV basically means the market expects the stock to be more volatile and increase in price of the options. Okay, you want a higher IV because the price of the options are usually more. All right. First things first, let's do the example. This is the current share price. It's always going to show you the current share price when you're looking at an options trading board or whatever. And now let's determine if we want to sell or bet on the price to go up or down, right? I'm just going to bet that the price will go down. So So what will I do? I will switch it to puts, and we're gonna take a strike price below this current price, and you're gonna pick the expiration date. We're just gonna pick tomorrow, make it easy, and 414 would be the price I will choose, right? So it's gonna cost 43 cents, basically $43, because you got to remember this is times 100. It's 100 shares. The open interest is a good amount. Basically, people are interested in this contract. Implied volatility is low, so there won't be too. So basically, we're getting this contract for a decent price. It's not a high volatility. Delta is not so bad. Basically, we will get, if this price goes in our favor, we're pretty much getting $26 for every dollar it goes down. So if this actually hit this, we're actually going to be making, I don't know, $26 per contract. And theta is pretty bad because of how close the expiration is. So if we hold this contract tomorrow, it's pretty much worthless. And that is something you have to keep an eye on, okay? To trade this contract, you're pretty much going in for scalping. And scalping can be a different video, but that's how it would be. So if you wanted to buy this contract, it would be $41. Your max loss is $41, and your max profit is all the way up to 41,000 if the SPY goes to zero. Okay, guys, I hope this helps. Please like and subscribe and follow for more content. Okay, we're gonna go over some new videos next time, and a lot more different strategies and more details on options. All right, guys, appreciate it.